Today we're joined by Luke McNally from YesCanDoMortgages. We're going to talk about all things mortgages this morning. Thanks for joining us, Luke.
Thanks for having me.
So, can we just start off? The big question for someone who is just thinking about buying their first property. What do they need to do? Where do they start?
Speak to us. So our role as an intermediary or mortgage broker is to establish their objectives, their preferences, but more importantly, their incomes and circumstances so we can confirm who can help. Utopia is lots of lenders will give them what they want or need. And that's where our advice comes in because we narrow down thousands of products to the best ones they're eligible for.
So what would you need to know from them? What sort of specifics?
The basics, incomes, outgoings,
Right.
deposit sources.
So in other words, where they've got the deposit from.
Absolutely. Yeah.
That's important now, is it?
It is. I mean, you got to think there's 90 plus lenders. They've all got different criteria. We've got to satisfy anti-money laundering with a solicitor. Do that from day one, effectively. Our job is to make it fit, but more importantly, lead it by who's cheapest, who's best.
Right.
And our role is to assess everything that they've shared and provided, like a lender will, so that there's nothing that's going to come up at application. So yeah, all of that's really important initially, just so they've got a good idea. If they're out there viewing, they can achieve it and they're happy with the repayments they're eligible for.
There's a lot of talk about people having car loans, people having gym memberships, spending a lot of money on takeaway coffees and
Don't we all?
and things like that. And does that affect?
It does, yeah. So your affordability or borrowing power is not just on the incomes that we can assess and verify, it's also on your outgoings. In its simplest form, if you had a base salary of 30,000 and no commitments, you're going to borrow a bit more than if you had the same salary but a £250 car loan. So lenders are interested in committed expenditure, things that we have to pay when the mortgage starts. They're not so interested in things you can shop around for or cancel, like gym memberships,
Right.
subscriptions, food.
Right. So there's a little bit of good news there, that you can keep your gym membership and
Yeah.
you can keep your Netflix and you can get your takeaway coffees because you can stop them according to the lenders. Yeah.
Even within that, we assess borrowing there and then. And it might be that someone can't quite meet their objectives, but we're able to say, look, can you repay this? Can you cancel that? Lenders have an appetite where they can ignore commitments that aren't going to be there on completion. There's so much to confirming affordability, not just on the initial advice, but on the decision in principle on the application. And there's opportunities to influence your borrowing by tweaking commitments, evidence and more income they might not have thought they could use. All that goes into a calculation. And like I said, ideally, you can meet your objectives now, many lenders, but for some they can't. And we're able to say, right, if you do this, this and this, our options improve.
Right. This is something I hear a lot when people say, I've worked out what I can borrow. I know roughly what I can borrow because me and my partner, we've got a joint income of so much, and you just have to multiply that by 4.5. Is it as simple as that?
There is truth in that, yeah. So lenders have income multiples. However, it's not as straightforward as that. Lots of lenders offer higher income multiples, particularly for first-time buyers.
Okay.
And particularly for those that earn over a certain threshold. And that's where our kind of advice comes in, where we're considering every single lender, not just their appetite to lend, but their products. A lot of people say, crikey, I don't know how I could borrow that. Whereas if they go into a bank and had one answer, they might have in their head that's what they can borrow.
So quite a huge advantage into coming to an independent financial advisor than just going back to your bank, because there is a lot of shopping around that needs to be done first.
The analogy I used to use, if you go down a high street when they're all open, it could take you 5 or 6 hours going to 4 or 5 banks, get an answer, how much you can borrow, and also see what products they're offering. As an intermediary, we've got access to over 90 lenders,
Right.
And we can do it in seconds. I'll typically do it on what they tell me first on the initial call. Give them all that information, everything you told me. This is your borrowing power. The key thing is, a lot of people say, well, my bank do it for free. So do we. We don't charge. Yeah, don't waste your time getting lots of answers from several banks or building societies. Come to us, we'll do it in seconds. We're regulated to advise on the best products you can get. So it always comes back down to mortgage products, not interest rates, which I'll come back to.
Right.
But yes, shop around, because it might mean that you get a better product.
And by product, you mean a lender that will lend that suits your needs.
So product, people are obsessed with getting the lowest interest rate. That's the wrong way of looking at it. You've got these comparison sites where they can just put in a bit of information and pull off the lowest interest rate. What that emits is fees, cashback incentives, Terms and conditions. A lot of lenders got to have an account with them, or the property's got to be energy efficient, or you've got to have a certain profession. It misses all these terms and conditions that we're aware of. What we're able to do is actually advise on the best products, and the product is inclusive of rate, fees and cashback. If I use an example, lender A's got a 3.69, but they're going to charge you £999 to get it. Whether you paid that fee or added it, that's actually not the cheapest product.
Will you do that over the long term, saying that this is the project you're taking, and if you add all of that into it, financially, it's not the best one for you?
So we look at true cost over our chosen fixed rates. If you come to me and say, look, I really want to fix for 2 years, right, over the 2 years, yes, this is the lowest interest rate, but it's actually costing more money. We're better if I use that, 3.69 as an example. You're better off on this 4%. Yeah, the rate sounds higher, but they're not going to charge you a fee, and you're going to get a bit of cash back.
No, you do need to look into things, don't you? So can you just explain a little bit the difference between a fixed term and a variable rate then?
So fixed rates tend to be the most popular. It sounds obvious, but you secure or you lock in your interest rate and your monthly repayment for a period of time.
Right, and the interest rate stays the same, so you know what you're paying for that whole period. No changes, and that works if interest rates are going up.
Correct.
What about if interest rates come down? You're still paying the same.
Great question. It all depends on whether you've completed or not. So we all know that this process can take months.
The house buying, the home buying. Yeah.
Mortgage application tends to go in as soon as your offer's been accepted. Secure your initial rate. Should our rate reduce between the initial application and completion, our system actually informs us, and we'll go back to them and say, thank you very much for our initial product. We want to change it to this. What will then happen is the lender will reassess and reoffer. The moment you complete, you're locked in, you're secured.
And after completion on a fixed rate, if the interest rates go up, if the interest rate come down, that's what you're paying.
Not affected, absolutely. Yeah.
Variable then?
A lender has a variable rate. They largely control that, and they can change it when they like. You can go on a lender's variable rate, but it's going to be one of the highest rates. The main feature of that is there are no penalties. So for people looking at selling, people in between moving, variable rate is a solution. Although the repayment's going to increase, it gives them the freedom to redeem it by simply selling it or going to a new lender without penalty.
So you mentioned that there will be penalties. So on a fixed rate, if you want to change lender, if you want to move, if you want to do anything within your fixed term, what happens?
All lenders' early repayment charges vary, but loosely, if we take a 2-year fixed rate as an example, the early repayment charges could be something like 2% in the first year, 1% in the second.
Oh, so quite a hefty amount.
It's quite a hefty amount, yeah. And they only really apply for 2 reasons. One is if you redeemed the mortgage. So if you sold the home and went in with family or rented.
Right, okay.
The other one is if you remortgaged to a new lender, and it might be for several reasons. They've got a blinding product. You're moving. Yeah. You want to borrow more for home improvements. You want to consolidate debt. And then the longer you fix, the higher those repayment charges are.
And then if you port your mortgage, you want to stay with the lender, you're happy, but you want to move. What can you do then? Still penalties?
Yes and no. So I always say to clients, if you want to move, you want to move. And it's because of a home or you're upsizing or whatever it might be. Don't try and align it with your fixed rate ending. That can be more problematic because you've got 2 transactions to deal with, a fixed rate ending and a purchase. So if you ever want to move, the first thing we do is consider your current lender. Now most lenders have a feature called porting, fancy word for taking your mortgage to a new home.
Yeah.
It's a full assessment. We not only take your mortgage to a new home, some lenders allow us to borrow more, change the term, but essentially we consider your lender first because by staying with them and porting, we're not leaving. So we avoid those penalties.
Oh, okay.
Now there are scenarios where we have to leave. It might be that the lender doesn't like the property. Our lender isn't lending us enough to meet our objectives where another lender is. First port of call is, can our lender do it? If not, we've got to work out those repayment charges and treat it like a cost.
So a little bit like we were saying in the beginning, that you'd have to go back to all the products and then do a cost analysis really of, is it going to be better for me to port and stay with who I am without any penalties, or do I pay the penalties because I'm still going to get a better deal, or I can get what suits me better?
Absolutely.
Final question, Luke, for the moment. Inflation went down.
Great news this morning.
Yeah, what's that going to mean?
So from what I read this morning, it's reduced a bit more than what was expected. Now, broader lending, we look at Bank of England, so their target is to get inflation to 2%, and it's been a battle for years. The 3% today is the lowest it has been in years. That's really promising because the nearer it gets to the Bank of England's 2% target, the more confident we're going to be they're going to lower their base rate. Now when they met this month, it was a close decision. I think it was like 5-4 to hold it. So we already widely hope rather than expect that when they meet in March, they're going to drop it again. Now, fixed rates aren't directly linked to the base rate. Bank of England make their decision. Lenders often price in their products before. So inflation is, coming down is hugely positive because it then brings more confidence that the Bank of England will drop the base rate.
Right.
In loose terms, that makes borrowing a bit cheaper. It gives more confidence in lenders. They lend short term as well as long term. And I think, the more they come down, the more confidence it'll bring to buyers, sellers, our world, everyone.
Thank you for that, Luke. That's
My pleasure.
been really helpful. I hope you've all found that really useful and helpful. And we look forward to seeing whether Luke's predictions on the base rate coming down in March will happen.
Thank you so much for having me. It's been a pleasure.